It was already declared dead. The timeline was flooded with it. XRP is finished. No momentum. Regulatory fatigue. The red candles stacked one after another, slow and suffocating. Volume faded. Volatility collapsed. It felt like the market had quietly closed the book, and then the filing hit. Not a dramatic victory, not a celebratory announcement, just a document, technical language, procedural adjustments, the kind of update most retail traders scroll past without reading. But I read it, and while everyone else focused on the past, on years of uncertainty tied to the battle with the U.S. Securities and Exchange Commission, I noticed something different. The tone shifted, the posture changed, and within hours, XRP moved. Not violently at first, just enough to break structure, enough to force short sellers to reconsider, enough to wake up liquidity. By the time the headlines caught up, the positioning had already begun. Here's what unsettled me most. The market didn't react emotionally. It reacted strategically, which means someone was ready for that filing. And if they were ready, then the real story started long before the document went public. Let me show you what I found. When the filing dropped, most people ignored it. It wasn't flashy. It wasn't packaged for social media. It was procedural language tied to ongoing regulatory clarity between Ripple Labs and the SEC. But I noticed a subtle shift. The language wasn't defensive. It was confident. Deadlines adjusted. Arguments narrowed. The scope of uncertainty felt contained. Markets don't need total victory. They need reduced risk, and reduced risk is exactly what this filing implied. Within minutes, XRP ticked upward. No explosion. Just steady buying pressure pushing into prior resistance. Shorts that had grown comfortable during weeks of stagnation suddenly found themselves exposed. The most telling detail: funding rates didn't spike dramatically. This wasn't retail FOMO reacting to a legal headline. This was capital stepping in calmly. And calm capital is rarely surprised, which made me ask a dangerous question. Who knew this filing would matter before retail did? Before the filing, sentiment was heavy. Open interest leaned slightly bearish. Social media mocked XRP's lack of movement. Traders were comfortable shorting every small bounce. That comfort is liquidity. When I zoomed into derivatives data, I noticed clustered short positions just above key resistance levels. If price moved through those zones, forced buying would trigger automatically. And that's exactly what happened. The breakout wasn't dramatic, but it was precise. Price climbed just enough to force short liquidations in waves. Each liquidation became a market buy. Each buy added fuel. But here's what stood out. Spot volume led the move. That means this wasn't just a squeeze. It was supported. Someone was buying before the squeeze accelerated. That's not coincidence, that's preparation, and preparation suggests anticipation. After the initial breakout, I checked on-chain flows. Large XRP transfers began moving off exchanges, not frantic withdrawals, structured movements. When distribution happens, supply moves toward exchanges. When accumulation happens, supply moves away. This looked like accumulation, and the timing aligned too perfectly with the filing to ignore. It's possible whales simply reacted quickly, but whales rarely react blindly. They position based on probability. If the filing reduced legal overhang even slightly, institutions would view XRP's risk profile differently overnight. And institutions don't tweet. They transfer quietly, which made me realize something uncomfortable. Retail was arguing about whether the filing really mattered. Whales had already decided that it did. Hours after price began climbing, headlines finally caught up. XRP rises on legal optimism. Simple, clean, convenient. But by the time those articles were published, XRP had already moved significantly off the lows. That lag matters, because retail traders who wait for confirmation through mainstream coverage almost always enter late. Markets front-run clarity. The filing wasn't the trigger, it was the confirmation of positioning that may have started days earlier. When I zoomed out to the weekly chart, I noticed something subtle but powerful. The breakout reclaimed a long-standing structural level that had acted as resistance for months. That's not a small technical detail, that's narrative shift territory, And narrative shifts don't happen randomly. Before the filing, exhaustion dominated. Holders were tired. Years of legal tension, delistings, relistings, endless debates. That fatigue is dangerous because fatigue creates underpositioning. When positive developments finally appear, exhausted holders hesitate. They wait for certainty. They distrust the move. Meanwhile, capital that remained patient steps in. The market doesn't reward emotional endurance alone. It rewards strategic patience. And what I'm seeing now isn't blind optimism, it's recalibration. XRP isn't being chased aggressively, it's being reassessed. That's far more powerful. I always ask one question after regulatory developments. Does this change the asset's perceived long-term risk? If the answer shifts even slightly toward less risk, institutions reprice, not loudly, incrementally. If banks or funds previously avoided XRP exposure due to legal ambiguity, a filing that narrows uncertainty changes allocation models. That doesn't create a vertical candle overnight. It creates gradual demand, which is exactly what we're seeing: higher lows forming, selling pressure weakening, no aggressive distribution into strength. That's not euphoria, that's repricing. And repricing phases often precede stronger trend expansions. Technically, XRP just did something important. It reclaimed a level that previously acted as a ceiling during uncertainty. Markets remember levels tied to legal risk. Breaking above them isn't just technical, it's psychological. Traders who sold in fear now face re-entry decisions at higher prices. Short sellers feel less comfortable. Neutral observers begin paying attention again. That's how momentum rebuilds. Not through hype, through structure. And structure right now looks different than it did weeks ago. When people said XRP was finished, they weren't analyzing data. I watched it happen in real time: the comments, the threads, the dismissive tone. But when I looked at the charts, the order books, the on-chain metrics, I didn't see collapse. I saw compression. What they were expressing wasn't analysis, it was fatigue. Years of regulatory tension, endless debates about the case involving the U.S. Securities and Exchange Commission, delistings, relistings, every rally questioned, every dip exaggerated. Fatigue distorts perception. They mistook consolidation for decline. They saw sideways movement and assumed decay. They mistook silence for weakness, as if an asset that isn't constantly exploding upward must be dying. But markets don't move in straight lines, and silence in financial structure is often preparation. Preparation looks boring, it looks uneventful, it tests patience, it slowly squeezes volatility until most participants lose interest and step aside. That's when positioning happens. The filing didn't magically fix everything, it didn't erase the past, it didn't guarantee a parabolic future. What it did was far more subtle and far more powerful. It shifted perception, and perception drives capital flows. Institutions don't wait for perfect clarity. They adjust when probabilities change. If legal risk decreases from high uncertainty to manageable uncertainty, allocation models shift quietly. Exposure limits expand. Risk committees relax slightly. That doesn't create fireworks. It creates steady demand. Here's the warning: if you treat regulatory clarity as a binary event, win or lose, approved or denied, victory or collapse, you'll miss the most important phase, the repricing in between. Markets rarely wait for the final verdict. They anticipate. They price in expectations, gradually, unevenly, sometimes painfully slow. XRP wasn't resurrected overnight. It was revalued. Revaluation is subtle. It shows up in higher lows forming after months of suppression. It shows up in declining sell pressure. It shows up in exchange reserves stabilizing instead of expanding. It shows up when bad news stops pushing price lower. And markets don't announce revaluations in advance. They reveal them through structure, through how price behaves after fear, through how quickly dips are absorbed, through how resistance levels eventually stop rejecting. Structure speaks before headlines do. So now the real question isn't whether XRP was finished. The real question is whether this filing marked the beginning of institutional comfort, because comfort changes behavior. If institutions feel even slightly more secure holding XRP exposure tied to Ripple Labs and its ecosystem, accumulation begins quietly. It doesn't need social media validation. It doesn't need retail enthusiasm. It just needs time. And here's the part most people miss. If institutional comfort is building, the biggest move won't happen during headlines. It won't happen when every outlet declares victory. It won't feel safe. It will happen during disbelief, during hesitation, during moments when traders say, I'll wait for confirmation. By the time certainty arrives, by the time analysts agree the risk is gone, the repricing will already be well underway. And the easy opportunity, it won't disappear in a dramatic crash. It will fade quietly, replaced by a new higher range that feels expensive compared to today. Markets don't reward those who wait for applause. They reward those who recognize structural shifts before they become obvious. The question isn't whether XRP survived, it's whether you can recognize revaluation before it feels comfortable, because comfort is expensive.